Hello, I'm Ross Bird, Equity Strategist for Aegis Equities Research. With me I have Peter Ray, Stock Picker for the Aegis Alpha Power Portfolio.
Back in your quarterly strategy review written in April for the June quarter, you indicated that you thought the Australian economy was better placed than perhaps the US economy, which was heading towards recession. What are your current views on the US economy and where it is likely to head over the next few months?
Yes, Peter, the outlook for the American economy in particular we had was rather negative, and we felt the Australian economy would fare relatively better, mainly because of the additional input from our resource sector that has been enjoying good times on the back of strong demand from Asia, in particular China and India in recent years. Over the last few months, those conditions have continued to remain buoyant. Indeed, we have seen iron ore and coal prices in particular rise in annual negotiations, and iron ore volumes have increased in addition to those prices. The overall effect then for the Australian economy is one of increased exports going forward, and therefore we have if you like, a buffer against some of the other rising input costs such as oil prices that the American economy, for instance, will be feeling quite severely by the American consumer in particular. So our view of 3 months ago is essentially the same now for those reasons, and we continue to see a deterioration in the American economy linked to the US consumer and the flow-on effects to housing activity or lack thereof, and also retail spending activity.
Ross, back in April, the All Ordinaries Index was around the 5,400 mark. At that time, you were indicating that you expected the market to be perhaps slightly higher than that in 12 months' time. Since then, the market has gone up, but then it's come down again, of course, and the index is now roughly around that same level, the 5,400 mark. Where do you see the index, the All Ordinaries Index, in 12 months' time from now?
It's a good question, Peter. The current market turmoil, shall we say, makes forecasting difficult at any time, but in this particularly volatile conditions, market direction and magnitude of movement is always difficult to predict. Our view, as you said 3 months ago, was for a modest 12-month return, roughly about 10% in total, including dividends, from a top-down perspective. I see no reason to change that view at this point in time. As we've said, our resource sector continues to enjoy buoyant conditions, and there's a number of associated companies that also benefit from those conditions, such as construction and engineering companies, and some other service companies that are linked to the resource sector. So overall, we're looking for a continuation of that general magnitude of 10% over 12 months. We still believe that will fare better than most overseas Western markets, because mainly of that resource exposure we have, and therefore on a relative basis the Australian market looks reasonably attractive.
So Ross, what are your preferred sectors in the market? Obviously you've talked about resources. You expect that to be a key driver of the market over the next 12 months, so that must be a favoured sector. Which other sectors do you like? And perhaps you could tell me about the sectors that you don't like, those that are going to perhaps underperform and drag the market down.
Yes, certainly, Peter. The resource sector is certainly one we continue to look favourably upon. The relative performance of different sectors has been quite large in recent months. Indeed, sort of starting back from October last year, when the general decline in the market began, we've seen some quite divergent performances, and so to a degree, some of the sectors that we had negative views on and have underperformed, in a way, have become a little bit better value, shall we say, than what they were, and therefore our views on them are not as strongly negative as they were, but nevertheless we remain cautious and, if anything, sort of neutral on them. So we continue to favour resource stocks, energy stocks, utility companies that aren't over-geared, that have exposure to energy, transportation and distribution, and also those sectors that have a defensive element to them in these uncertain and volatile times, such as telecommunications sector, healthcare sector by and large, with its sort of semi-regulated and sort of government sort of funded type of business model, and a number of subsectors, shall we say, such as construction and engineering. But that subsector we do like in amongst many other sectors that we don't have quite as a favourable viewpoint. In terms of sectors we have an underweight or a negative view to, consumer discretionary sector remains of a concern, even though it has significantly underperformed in the recent months, and also those companies that are heavily geared. Many of those are within the infrastructure and utilities sector, but the emphasis is on gearing and interest cover, and the need for refinancing in the short to medium term. So we remain cautious and careful, if you like, of those stocks fitting that criteria.